High growth stocks, something every investor should have in their portfolio, and that is what we're looking at today. We're going to uncover 8, and what we really want to see is companies with earnings per share expected to double at a bare minimum, which when we look at the S&P now, many of these companies will hit those criterias. We also want to see them growing their revenue at double-digit rates. For example, when we look historically at the S&P, there are companies that have been doing it, but we are finding there are only a few that have been doing it on a continual basis over the last 5 years, and ultimately we want companies that we project will outperform the S&P. When we look, in fact, over the last 10 years, many of them have been doing just that, but there are some that we see as very, very good standout plays. Now, it's worth highlighting, we are sort of towards the end of Q2 earnings in the S&P, and whilst the majority are beating, we are seeing some very small percentage where they are surprising on the upper end, and that's something that's only been increasing over time. The quality of companies in the S&P are getting stronger and stronger, which means it's harder to identify those that can outperform. And in fact, we have the trickier element as the majority of the companies performing very strongly are some of the biggest, as we can see, the top 10 against the others, but that trend may not always continue. So 8 high growth stocks, we're going to cover each one and just discuss our own valuation. The first one, Micron Technology, they had some very good numbers in their latest earnings, and ultimately this is one that is tied into artificial intelligence. Of course, they are going to benefit massively from surging AI data center demand with memory chip prices rebounding, industry supply tightening, so this is going to set them up for a strong multi-year growth cycle. And these companies that we've selected today, when we just take a look at some of their gradings, we want to see on the growth around an A, B in fact at the very least. And the first one, Micron Tech, up 17% over the last year. Year to date, phenomenal run, up 41%. Over the last 10 years, this one, like the majority today, massive outperformance of the S&P, up 545%. Now it is trading near its 52-week high. Having said that, Quant give it a strong buy, 4.95 out of 5, and Wall Street with their buy signal of 4.47, that is very near 4.5 to flip them as well into a strong buy rating. So it looks like analysts all in agreement, this one for serious consideration. And if we take a look at the forward P sitting around 10.4, that is below the 5-year average of 11.9. Remember, this is what we would call an undervaluation signal, but we don't look at these models in pure isolation. Worth flagging, the yield on offer to investors at 0.4% is slightly below historicals at 0.55. And if we were to show the blue tunnel, which as always does highlight within the parameters the intrinsic price, we're seeing a little bit of disparity just outside the bottom end, so still comes under that undervaluation signal, something we have seen for little periods during the last year. And whilst on the valuation grading it does get a C, we can see against the sector median trading at a 33% discount against their own 5-year average, again quite another significant discount. Something you can argue for the large part against the sector, or in fact against their own 5-year. This one is looking very attractive, but most importantly we want to see growth where they get an A+. Year-on-year revenue up 58%, expected this year 45%, well above the sector median, we're talking mid-single digit, but also they're increasing their revenue faster than they have done on a historical rate. Only thing that looks a bit disappointing, although this does fluctuate, their expected EPS growth around 5%. Different analysts have this in a different bracket, some believing, as we can see here, 122%. So these may be slightly different depending on the analyst, but overall a very strong growth grade at an A+. Now each one of these we want to discuss our own intrinsic price where it gets to $128 derived from the DCF model. Now you can see we have the growth rate at 10%. We've used 2025 as expectations from management for this full year. Now 10%, as we said, we have a low, medium and high here. We've gone for a slightly wider variation, 6, 10, 15. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running your own numbers, MU or any others, but effectively growth grade, discount rate, gives us the present value of future free cash flow, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving us today, if you believe this rate to be appropriate, 128.8% upside. Also on a reverse DCF, 8.8% is already baked into the numbers, gives you a good gauge. If you believe it should be higher, then ultimately you see it as undervalued, and vice versa. Full transparency as well, 6%, $99, downside of 16, and at 15%, 176, upside of 49. Now we're not done there because we always take through the middle rate where we apply a margin of safety, 10%, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. It's not that far off at 115, 116. That is where we see Micron Technology today, if you believe the growth rate of 10% to be most appropriate. For those that want to see a larger margin of safety at 15%, a buy at 109, at 20, 102, and at 25, $96. So Micron Tech, 10% MOS, Wall Street themselves see this at 153 into next year. They're very bullish, upside of 30%. As we said, a near double strong buy rating. And what we can also flag for those that believe the growth rate should be higher at 15%, you are ultimately getting a larger margin of safety. At 20%, a buy at 141, at 30%, 123, and at 35, not quite there yet, so sitting somewhere around 30 on that higher growth grade, 10% on the lower one. First growth stock, Micron Tech, give us your thoughts, buy, hold, or avoid. And we just want to let you know we have minutes ago released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next growth stock is Visa, where their latest earnings highlighted revenue looking very strong. Consumer spending doesn't seem to be slowing down, at least for the time being. And remember, they have a dominant global payment network and consistently produce double-digit earnings growth, making it a high quality play on long-term shift from cash to digital payments. Now it is up 27% over the last year. Year to date, up around 7%. It had a bit of a bumpy ride not that long ago, if you remember, around the stable coin situation, which we have covered before. Over the last 10 years, again, another outperform of the S&P on a bit of a pullback from 52-week high, where we get a double rating of buy from Seeking Alpha and Wall Street, 4.33, not far off 4.5 for a strong buy, and their forward PE 27.1, not dissimilar from the average, same to be said on the yield in fact, so we would say both signals here highlighting a reasonable valuation, of which is also confirmed when we take a look at the blue tunnel. Nice to see it also increasing over the longer term. As of today, sitting right in the middle, definitely one for consideration if you like high quality companies, you want to perhaps dollar cost average. And if we zoom to the last 5 years, this is looking gorgeous, where the expected price has just been on an incline year after year, and also periods where in fact it has given investors time to buy this at a severely undervalued level. As always, make sure notification bell is on because we will highlight when these companies do drop. Now, valuation grade at an F, ultimately highlighting it's trading at a 178% premium to the overall sector, something we see no matter which metric we look at. Remember, some companies it is worth paying a premium for, and that's highlighted when we look at the growth year on year and forward looking. As we said, double digit, very consistent, pretty much in line with their own 5-year average, higher than the sector, which sits around the 7% point. EPS as well, same to be said, around the 13% mark when the sector comes in at 10.5, although slightly slower than the historical 16. Now our valuation, $350. Bear in mind, we have used a growth rate of 12%, with currently baked into the numbers 11.5. Now, one thing that's interesting, which we will come on to, is the 14% gives a value of 402. That is where essentially Wall Street see this in the next year. they believe upside of 20%. So we'll cover right now both the medium and high rate in terms of a margin of safety. As of today, if you believe the medium rate, we're talking around a 5% MOS at 332. Not quite there yet. Again, as we said, high quality companies, dollar cost average can be a strategy. 10% a buy at 314, at 20, 280, and at 25, 262. And if you're more in line with Wall Street where they see 14% growth, you will naturally get a larger margin of safety. Not at 20% just yet, that would be 322. At 15 is pretty much around where they sit. If you're in agreement, then could be a case to really consider adding. And whilst we do typically cover Visa more on the channel because it does look typically to be more undervalued, you can also include MasterCard under this bracket. Let us know Visa for the longer term, buy, hold, or avoid. The next one we're moving on to is ServiceNow, where in their latest quarterly earnings, revenue was up double digit, 22%. We can also see, always good sign when companies outperform Wall Street, and the same thing is they've added $900 million to their remaining performance obligations. Analysts were expecting this to be a drop to 270. So overall, analysts were surprised. This is a company that continues to climb in the numbers, and in fact, they're an industry-leading workflow automation platform whereby they're riding the unstoppable wave of AI-driven digital transformation, driving rapid revenue growth, expanding profit margins. Up 8% though over the last year. They're down 18%, which could make it an interesting one for consideration. Over the last 10 years, up more than 1,000%. Now, they are sitting towards the lower end of the 52-week range, where we get one strong buy rating from Wall Street, although we should flag for a growth company, forward valuation sitting at 52, definitely something to take a closer look at. And you're not surprised to see these sectors sitting lower. You're paying a 129% premium, but actually you're getting a 30% discount to their own historicals. In fact, right across their own 5-year average, this is now trading at a double-digit discount, but pretty much a triple-digit premium to the overall sector. And growth, naturally, you want to see very high given the valuation, given the premium against the sector. A- year on year and expected this year at 20%. Again, sector a lot lower, mid to high single digit, but actually they're growing their revenue a little bit slower than their 5-year, which makes sense then why they're trading at a bit of a discount. But interestingly, EPS 34% is above their 5-year at 33, well above sector at 14. Definitely a strong growth company purely on these metrics. In our valuation, $1,091 is derived using a growth rate of 20%. Baked in right now is 16.7, but just look at the last 3 years. We're talking 26, 24, 21. Even before that, this is one that just continues to rise. So you could in fact say 20% is a bit more on the conservative side, but using that, you are getting a margin of safety of at least 10% up to 982. At 20%, 872, pretty much bang on. Wall Street also see upside 32% into next year, strong buy rating, $1,150, and for those that want to know, 25%, 818. Let us know, ServiceNow, your views, great buy for the longer term, or maybe one to avoid. We then move on to Eli Lilly, one that we have covered quite frequently on the channel given how much of a drop we saw. Now, main reason for this was ultimately the weight loss pill wasn't seeing as much weight loss, we should say, as what analysts wanted to see. Wasn't massive, but still companies will be punished, and ultimately they are now trading pretty much at a 52-week low. Worth flagging though, they have increased their full-year guidance, and they're leading the booming weight loss diabetes drug market with their blockbuster treatments, and that is why we are seeing this as a very, very explosive growth company and long-term potential upside. Now, over the last year, they've lost 1/4 of their market cap, down 25%, year-to-date down 20%, but another outperformer of the S&P. We also note a double buy from Seeking Alpha and Wall Street, where we get a forward valuation below 24 when historically it sat at 38, yield around the 1% mark, slightly below historical 1.2, and again severe undervaluation. Great to see the blue tunnel as well moving upwards. In fact, share price going the opposite way. This is where opportunities lie. Share price decreasing over the last year, intrinsic value going the other way. And actually, over the last 5 years, you wouldn't have been able to get this in severe undervaluation, something we're just seeing in the last few months. Valuation grading at an F, whilst it has been coming down, you're still paying a 61% premium to the sector, 36% discount to their 5-year, but consistently, this one has always been trading at quite a large premium. We would say it is warranted because when we look at the growth at an A+, year on year 37%, expected this year 28%, well above the sector around the 7 to 8%. In fact, this one growing faster than their own 5 years, earnings per share also expected to follow suit, 32%, sector comparative at 10, and their 5-year lower at 22. Now, our intrinsic value at 691 is saying baked in is 33.5%. That is quite a lot. You can see ultimately you need around 35 to 40 to get any kind of upside projected, at least in the shorter term. But what we're saying right now, using the middle rate, you are getting a margin of safety pretty much at 10%, something we've not seen in quite some time for Eli Lilly. Wall Street themselves, 980 into next year, still very bullish, upside of 57%. If you want a 20% MOS, 553, 25, 519. Eli Lilly, is it worth it now at a 10% margin of safety? Yes, no, or in fact, one to completely avoid. We then move on to Bristol Myers, one that saw a very strong earnings. Remember, they do offer a deep pipeline of cancer and immunology drugs, strong dividend, which we're going to come to show you, and they also recently signed a cancer drug deal. Now, this one is a little bit different to the others, where they are down over the last year 5%, down 19% year to date, but over the last 10 years, they're also down 28%, the only one that will have underperformed the S&P. But they're trading right there near the 52-week low, one singular buy rating from Seeking Alpha, and whilst we won't go through every single one, A+ right across the board, valuation, growth, and profitability. Now we get that undervalued signal, forward P 7.3 below 8.3, yield super attractive at 5.4%, well above the 5-year of 3.4, and because the yield is high and in fact massive disparity from the average, we'll flag dividend safety score looking decent at a 70 safe level, where we also get the severe undervaluation just outside the bottom end of the fair price. Not the greatest that the blue tunnel has been decreasing, but looks at least in the shorter term to be reversing the downward trend. And A+ on valuation, making it incredibly interesting to take a further notice. 59% discount to the sector, 62% discount to their 5-year, discounts right across the board. Now, growth grade at an A+, we can see year on year 3%. They are expecting a drop of 1% in 2026. Sector does look a lot higher, including their own 5-year average, where we did see double digit. But one thing that looks very promising is the earnings per share, projected 61% growth, well above both sector and their historical. And our valuation of 60, the average of the 3 models on screen, will give rise to a fairly nice margin of safety. At 20%, a buy at 48, at 25, nearly there, and you are getting a fairly strong yield. $57 is where Wall Street see this into 2026. That is 24% upside. Bristol Myers Squibb, one of those, yes, it has underperformed, but perhaps this is a turning point. You are locking in a very attractive long-term yield where it does look to be safe for the time being. The next one has to be Nvidia, where whilst we're still waiting for their latest earnings, in the previous one it highlighted that demand continues to be surging, although there is some uncertainty, at least when this was released, due to the China restrictions. But we have breaking news today, in fact, that Nvidia and AMD will be able to sell their products in China, but the US government is going to want a 15% cut directly on those chips that are being sold. Now, in the pre-market, doesn't actually look like there is any movement. It's down, we're talking just a few cents. Over the last year, they are up 67%. Over the last 10, significant outperformance. And remember, they are the undisputed leader in AI chips, and the demand, a lot of it in fact, coming from data centers. And this one, we should highlight, is trading at a 52-week high. Wall Street, nonetheless, strong buy rating, another buy from Seeking Alpha. And even here, we're seeing the forward P38 below, although marginally 5-year at 41.5. This is, again, a potential undervaluation signal. And now, for the first time in quite some time, we are seeing a reasonable signal. It is just within that blue tunnel. Great to see increasing intrinsic price. Something probably, at least for the longer term, we will be expecting if we do note these total addressable markets continuing to increase at the levels the CEO has been saying. And when we zoom out to the last 5 years, we can see really from 2023, the intrinsic price has been shooting at such a phenomenal speed. And at an F on the valuation, as you are paying an 87% premium, you are in fact, as we just showed, still getting a discount of 10% to their historical, huge premium to the sector, bit of a discount across the board to their own 5 year, but definitely warranted. We're talking growth 87% year on year, 61% this year, well above the sector, makes sense, the valuation disparity, and actually growing faster than their own 5 years. This is also reflected in EPS, projected 29% growth above the sector in line with the 5 year. In our intrinsic value, $164 does highlight at a 20% growth. There is a bit of downside around 9%. Given baked in is 21.5%. Now you may disagree, you'll think perhaps we will see faster growth continue, 25% may be more appropriate, and as we can show you here, 229 indicating 27% upside. So at 20, we don't see any margin of safety as of today. You may agree, you may disagree. At 10%, a buy at 147, at 20, 131, at 25, 123. Wall Street, even with their strong buy rating, have price target of $187, only means 3% upside, but if this is one you're holding for the longer term, then this is ultimately a very strong hold. And following suit in the same industry, we have Advanced Micro Devices with a fairly strong most recent earnings, where they seem to be rapidly gaining market share in AI and data center chips. Now they're up 30% in the last year. Year to date, very strong, in fact better than Nvidia, they're up 43%. Over the last 10 years, massive outperformance, and they too are trading near their all-time highs with a double buy from Seeking Alpha in Wall Street. Now their forward valuation, sitting at 44.1, is also trading at a premium of 95% to the sector, but also actually a premium of 11% to their own 5 year. And their growth looking good at an A, 27% year on year, 21 expected this year. Not as strong as Nvidia, but still much higher than the sector median. They are, however, growing slower than their own historical. Earnings per share projected 31% growth above the sector, pretty much around the same level as their own historical 5-year average. In our valuation of 162, given the current share price, does show it trading at a little bit of a premium. We've inputted 20% moving forwards. We can see already baked in is around 20.8. Now you may believe, again, like Nvidia, 25% to be more appropriate. Then we're talking $217, 28% upside. At 10% though, consideration for a buy at 146, at 20, 130, and at 25, 121. Wall Street themselves, again, not as much upside as maybe you'd want into next year. 182, 7%. Let us know, buy, hold, or avoid. The next one we're moving on to is Fair Isaac Corporation. Now this one is in fact seeing its monopoly face some pressure, but they have an expanding suite of advanced analytics, AI-driven risk tools, and they're opening up new growth avenues, which does keep the stock bullish for the future, especially as it has now been driven to 52-week lows. It's down 16% in the last year. Year to date, down 34%, 1/3 of their market cap wiped out. Nonetheless, over the last 10 years, still massively outperforming, up 1,357%, with a buy rating from Wall Street, a valuation around 45, trading at a 98% premium to the sector. We get here minus 2%, so pretty much trading in line with their own 5-year average. And their growth looking good, B+, we're talking 17% year on year, 15% projected this year. On both accounts, they're growing faster than the sector as well as their own 5-year average, and we can also see projected 28% growth to the EPS, well above the sector at 14, and also quite some way higher than the 5-year at 19. In our intrinsic value, $1,536 is derived using a growth rate of 20%, where we want to be even more conservative given the question around their monopoly, but you can see baked in right now is 18% to the free cash flow year on year, and if we just show you their most recent year, free cash flow was up 31%, so you could perhaps say this is a little bit more conservative. Right now though, not at 20% MOS, we're talking near a 15% level. Wall Street, they have lowered their price target, but still just under $2,000 indicates 49% upside. If you want to see it 20%, buy at 1229, at 25, 1152. And if you're more in tune with where Wall Street see this around the 25% mark, as we can see, not too dissimilar, the margin of safety will in fact be higher. 30% about 1537, at 40%, pretty much around those levels. Fair Isaac Corporation, it is coming under question, but it's now at a 52-week low. Does it make it more attractive? Do you see it as a buy, hold, or avoid? Do let us know. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.